touch base on some of the headlines that are breaking this afternoon. On CNBC, you should always have your alerts on for different news organizations, especially for business. CNBC, Bloomberg, anything related to stocks, real estate, or business, you should always have your alerts on to make sure that you're on the pulse of what's going on. So, breaking news today, 30-year Treasury yield hits highest level since 2007. After the Fed keeps rates unchanged, long-term yields climb to multi-decade highs. Let's go through this. So why does this matter? Higher 30-year Treasury yields make borrowing more expensive across the economy. This can lead to higher mortgage rates because especially the 30-year fixed mortgages can go up. Higher borrowing costs for businesses because the rates are higher, more expensive loans for consumers, pressure on stocks, especially expensive growth and technology companies. This is exactly what happened during the Great Financial Crisis, where the rates were higher and higher and higher, and they can curtail the amount of capital that you can get from a bank. What investors usually watch? Banks and insurance can benefit because they often earn more from higher interest rates. Home builders and real estate can struggle because mortgage rates can be more expensive, and that minimizes the amount of the window to get in. Would be best if the interest rates were low, but if they're going higher, it closes that door. Utilities and REITs often face pressure since investors can earn attractive returns from safer treasury bonds. And high growth tech stocks, which we see now, may see more volatility because higher rates reduce the present value of future earnings. And we'll talk about that shortly. And who benefits and who feels pressure? Who benefits? The banks. Higher rates can boost interest income. Insurance companies, higher investment yields improve returns. And who feels the pressure? The homeowners, the buyers, real estate, REITs, tech, and growth. So I like to leave something for you to chew on, something for you to grow, somewhere you can make money. So let's do that. Here are all the tickers for various banks and why you could benefit from higher rates. Here's a list. Makes your life easier. Pause it, absorb it, make a watch list. Here are insurance companies and their tickers. So again, why could it lead to higher rates and why could this benefit? The explanations are on the far right side. Key takeaways: higher 30-year Treasury yields means borrowing is more expensive for everybody. That's bad. Some sectors benefit, but many face headwinds in a higher rate environment. If you found value in this, please like and subscribe. If you want a deeper dive, especially if this market turns, you need to change strategies, you don't know how, please go to my Patreon page and learn more, dig deeper.